Yes, good afternoon, dear students, online students. Yes, are you all there? Right. Again, good afternoon to all of you, online students. Are you all there? Can you all hear me?
Yes,
Yes,
sir.
sometimes. Okay,
Yes,
fine.
sir.
Okay, is this document visible to all of you, which I have shared? I mean, the lecture material.
Yes.
Right. Okay. So, fine. So let's start. Good afternoon to all of you again. So let's start the final discussion. Okay. Today I'm going to complete your syllabus. Hopefully, 1 to 6 p.m. Alright. Right. And so today we are going to have a lecture from 1 to 6 p.m. isn't it? Then 1 to 3. 1 to 6. Okay, fine. Good. So, 1 to 4. Okay. Right, so it's 1 to 4, and today we are going to discuss about balance of payments and exchange rates. Right, so your final topic under business economics, and there's another topic which is for your self-study. So I think you might have seen that I have prepared a particular document for that one also, and I have uploaded it. Right, that is big always on economic crisis. Right, okay. Have you all downloaded this lecture material? Balance of payments and exchange rates. So yeah, without wasting much time, we'll start our discussion. Hope you all had your lunch. Had your lunch. Why less number of students? Huh? Why? Is there any reason? Still they are coming. This is the today's forum. Right. Okay, fine. With the next. Right. So we'll start now with balance of payments and exchange rates. So these are the things we are going to discuss under this particular topic. Introduction. We are going to discuss about components of balance of payments. The BOP issues. I will tell how I am going to do this. Key terms applicable in exchange rate, different activities in foreign exchange market, exchange rate determination, and finally exchange rate theories. These are the things we are going to discuss today. So once we complete this particular session, you should be able to understand how we are going to classify our balance of payments accounts, how we record transactions, what are issues and solutions, then key terms applicable in exchange rate, different activities in foreign exchange market, and how we determine the exchange rate, and finally the exchange rate theories. Right? Those are the things we are going to identify at the end of this session. It's 29, isn't it? Good. Shall we go to outside and do the lecture? Right, okay, fine. Now, introduction. Now, our topic is what? It's balance of payments. Have you heard this word before? Have you heard this word before? Balance of payments. Yes, online students, you can also do it with us. Balance of payments. What do you mean by balance of payments? What you say, tell you, what do you mean by balance of payments? Yeah. Sorry, okay, good. Transactions with other countries. Yes, is there any different answer? Difference between imports and exports. Okay, yes. What is the exports and exports? Okay, yes, online students, what do you think? What is balance of payments in a very simple way? And tell me what you feel now. You answer may be incorrect, correct, it doesn't matter. Yes, online students. Gayan, are you there? Gayan?
So
Gayan,
different.
are you there?
Yes, sir.
Yes. What do you think?
It's what you call whatever remaining in the trade account, that is import and export.
Oh, okay, fine, very good. Fine. So now let us look at what balance of payment is in a very simple way, right? Now, if you consider about a particular company, right? If you consider about a particular company, let's say this is JKH. JKH means what? Very good. It's John Cales Holdings, right? Now, what happens during a particular time period, let's say 1st of January 2022 to 31st of December 2023, they are doing their operating activities, right? They are doing their operating activities, buying and selling many things, right? Say diversified holding, and they do many things, right? Now, after some time, let's assume that after this date, they need to measure whether what is the performance of their operating activities, right? So they are doing operating activities for a particular period of time. So they need to measure the success of their operating activities. Clear? Accordingly, what they should need to do, they need to prepare what? They need to prepare they need to prepare what? Now from 1st of January 2022 to 31st December 2022, they are conducting their operating activities, and they need to measure the performance of their operating activities, and they need to get an idea about their current state. What are the things, so what are the documents that they may prepare? Simply they prepare their, very good, simply they prepare their financial statements. Right? Simply they prepare their financial statements. Now, you know that when it comes to the financial statements, we have the income statement, we estimate the performance of the company, whether the company earns a profit or make a loss. Then when it comes to the statement of financial position, they mainly consider about their current state, how much of assets do they have, how much of liabilities do they have. Then when it comes to the changes in equity, they represent the changes in order state, right? Changes of order state. Then the other document is cash flow statement. It represents what are the cash inflows, what are the cash outflows that has been realized based on investing activities, financial activities, and operating activities. And finally, notes to the financial statement. Clear? So now you know that if you consider about a particular organization, during a particular period, they are doing many activities. Let us call them as operating activities. Then they need to measure the performance of these operating activities, whether they success or not. For that, they prepare a particular document called financial statement. Clear? Good. Then, if we consider, right, if we consider a country, right, so this is Sri Lanka. Now, when it's come to our international trade lesson, last week lesson, you got to know that Sri Lanka can do something called domestic trade as well as they can do international trade, right? They can do international trade. Now, not only Sri Lanka, all the countries are doing transactions with rest of the world, right? All the countries are doing transactions with rest of the world, right? So let's say again, during a particular period, from 1st of January 2022 to 31st of December 2022, right? So they are doing imports, they are doing exports, stock market investments, foreign direct investments, capital transfers, many transactions related with other countries, as you mentioned correctly. Clear? Now, if I ask you why we are dealing with other countries, what would be your answer? We are doing domestic trade and why we are engaging with other international trades or international transactions for what? Now, if I put it in a very simple way, why you do this type of operating activities in a company? Because you need to make profits. Why you need to make profits? Because as a company, you are being funded by shareholders' funds, right? As a company, you need to maximize your profit. In terms of finance, you need to maximize your shareholders' wealth, right? Accordingly, you are working based on the funds given by them. So you need to operate in a proper way and you need to earn something for them as well as for the company. That's the objective. Then if we copy paste the same thing into this particular scenario, why a particular country engages in international transactions, so international trade? What could be the reason? Yes. Develop standard of living. Good, to increase the standard of living of the people, right? So we can import BMWs, we can import Chryslers, many things. So standard of living will be high. Good. Then simply as a summary, in a nutshell, we want to make a gain by engaging in international transaction. We want to make gains by engaging in international transaction. That is why the particular country is engaging in this international transaction. So these gains includes everything, monetary, non-monetary, everything. That's why we are dealing with the rest of the world. Then we need to measure actually whether we make a gain or a loss. Clear? Simply like this. To understand this, simply we have to prepare a particular document called balance of payments. Clear? Simply a particular document called balance of payments. We are dealing with domestic trade and we are dealing with international trade and other international transactions. Why we are dealing with the rest of the world? We need to increase our living standards as well as we need to make a gain by engaging in international transactions. To measure whether we achieve that objective, we are preparing a particular document called balance of payments, right? Balance of payment. So this is what you are going to learn to. Clear? Right. Good. Balance of payments. So here it says the balance of payments of a country, right, reveals the final outcome of its economic transactions with the rest of the world over a specific period of time. So during this period, you need to know you have done many international transactions, then whether you gain something or not. Then here it says, therefore, this balance of payment is a statement of all transactions made between entities in one country, entities between one country and the rest of the world over the defined period of time, such as a particular year. right? What we have done with other countries. Then further, the balance of payment is also known as balance of international payments, which summarizes all the transactions that a country's individual, companies and government bodies complete with the individuals, companies and the government of another country. Here we have Sri Lanka. Individuals are there, companies are there, government is there. Then these people are doing transactions with other countries, individuals, companies and governments. Clear? These transactions consist of imports and exports, services and capital, as well as transfer payments such as foreign aid and remittances. This is how you specifically define what balance of payments is, more specifically. Right, so here it says, specifically, the balance of payment can be defined as a systematic accounting. What do you mean by systematic accounting? It's double entry. Systematic accounting of all economic transactions between the residents of a nation and the rest of the world during a particular period of time. That is how you more specifically define what balance of payment is, right? It's a systematic accounting, right? All incomes are credited and outflows are debited. Okay. The counting of all economic transactions between the rest of the world, right, and the other countries during a particular period of time. Now here it says the balance of payment is the single most important aspect of international economics that matters most macroeconomic analysis. That's why we are preparing this. We want to know, to identify how much of foreign reserves that we have, what type of actions that we need to take. So simply by looking at the figures of the balance of payments, we can make policy decisions. That's why here finally I have mentioned, yes, it's a most important document. Why we are going to make some policy decisions. Clear? So this is balance of payments. Now let us look at why we prepare this balance of payments. Up to now, you have some sort of an idea, but let's see in a more detailed way. Right, now simply here I have mentioned the purpose. Here it says the purpose of the purpose of balance of payment accounting is the same as the purpose of balance sheet prepared by the firms. Statement of financial position. It clearly illustrates the assets and the liabilities that a company is having. Right. The purpose of the balance of payment accounting is to take stock of the country's foreign receipts and the payment obligations and of the assets and liabilities arising out of economic transactions with a view of taking stock of gains and losses. Simply, we are doing international transactions. We want to identify how much of receipts that we have, what are the outflows that we have done, how much of assets do we have, how much of liabilities do we have, by calculating the final answer. Right. So some other important uses of balance of payment account are as follows. Now the primary purpose is we need to identify whether how much of foreign income we have, foreign expenses, then simply what are the assets and liabilities do we have. We need to measure those things. Clear? Right. So then here it says there are basically three objectives when it comes to the balance of payment. Now the first one is here it says the balance of payment accounting serves a very useful purpose as it yields means produce, right? Necessary information on the strength and weaknesses of countries' international transaction. Strength and weaknesses, right? So for an example, in a very simple way, let's assume that our imports are higher than exports, which indicates that. Is it a strengthier situation or a weaker situation? It's a weaker situation, which means that we are having more imports means more dollars are flowing out from Sri Lanka. Less exports means we are getting more dollars. So it's a weaker point. We can identify and we can make some remedial actions. So that is the first one. We can identify the strengths and weaknesses of international transactions. Then the second one is by analyzing this balance of payment, we can identify certain trends. We can identify certain trends. For an example, let's say now 2022, we are having a particular value for balance of payments. 2021, we are having a particular value. 2020, again a particular value. 2019, again we are having a particular value. Right? So simply by analyzing these values, simply we can compare. Simply you can compare your profits, right? Like you did for your company, you are comparing your profits with previous years. Likewise, here you can compare the amount of the balance of payment with other years to get an idea about the trend, whether it is a positive trend or a negative trend. Now, what do you think about Sri Lankan balance of payments? Is it a negative trend or a positive trend? It's like that. It's a good trend, no? So we can identify. How we can identify? Because we are doing the comparison. Right? We are doing the comparison. By doing those comparison, we can identify. So here it says, by analyzing the balance of payments accounts of past years like this, one can find the overall gains and losses from international transactions, economic transactions, whether we continuously making profits or continuously making losses, or there are any up and downs, right? Simply trend analysis. It can be ascertained whether the composition and the direction of international trade and capital movements have improved or caused deterioration in the economic conditions of the country. Simply we can identify whether the things are collapsed or increased. That is the second objective of preparing a balance of payment. What is the first one? We can identify the strengths and weaknesses of the economic transactions. The second one is we can compare the figures with the previous years and we can analyze the trend. Is it a positive trend or a negative trend, or there are any significant fluctuations, significant spikes are there? Right. The third one is what? Now, if you have correctly do these two things, you can make policy decisions, right? You're analyzing the balance of payment and you're analyzing the weaker things and the strengthier things, and you did a trend analysis. By doing so, now you're in a position to make corrective actions if there are any insufficiencies, inefficiencies in the movements. So here it says balance of payment statements give warning signals for future policy formulation. So if certain governments got to know that, yes, our foreign reserve balance are little by little decreasing, they have to make that decision. We do not want to wait till the end. Right? If you particularly identify the trend, we can make the corrective actions. Clear? If balance of payment shows persistent large deficit over a period, look at that. If this particular balance shows a large deficit over a period of time, 2019 negative, 20 negative, 21 negative, 2020 negative, right? What happens? It means a persistent growth of international indebtedness, which means we have to pay to the rest of the world. We have to pay to the rest of the world. The high BOP deficit may cause financial bankruptcy, right? Which means, for an example, let's assume that here we have to pay 2.9 billions, right? 2.9 billions. It's a negative figure. This indicates that we have to pay this amount for the rest of the world. If we cannot pay this amount, the relevant authorities declare we as a bankrupted country. That's what happened. In terms of accountancy, we are not bankrupt, but in terms of economics, we are bankrupt. Right? A regular review of balance of payment provides guidelines for the formulating appropriate foreign trade and exchange rate policies. So we need to regularly review this, right? Not the year end. Continuously, we need to monitor. Yes, what has happened now? What is our import value? What is our export value? What about our capital movements? How about our foreign direct investment? We need to continuously review this. Continuously. If you do this, we can make these decisions very easily. Clear? So those are the three objectives of balance of payment, preparing balance of payment. First one is we can identify the strengths and weaknesses of international transactions. Then by comparison the value with previous years, we can identify the trends. right? Whether it could be a positive, negative, or certain fluctuations. Third one is by doing so, we can correct what you call, we can correct certain behaviors. We can make policy decisions, right? If we got to know that our foreign reserves are little by little decreasing, we can make a decision, but we didn't. So that's why something happened, right? Okay, so could you please read these two slides? If you have any doubt, you can ask.
Sir,
Yes.
sir, when we say economic transaction, is it include foreign loan also?
Yes.
Okay, so okay, thank you.
Okay, fine. Okay. We'll see. We'll see. Yeah, we'll see those things. Right. So up to now, are you all okay? Clear? So now you know what balance of payment is and what are its objectives. Yes, online students, are you okay with these things? Clear? Yes, online students, are you all okay with these things?
Yes, sir.
Right. So now simply, next we are going to discuss about components of balance of payments. Right. Next we are going to discuss about components of balance of payments. Now before that, let's see. Now this is an extract of the balance of payment document which I have taken from the Central Bank of Sri Lanka. Right. So balance of payments is an analytical presentation. You can also find if you go to the Central Bank website and the annual report, specifically they have mentioned these things. Right now, we are not going to look at all of these things, right? In a very simple way, we are touching these things. Now here you could say there are certain accounts are there. I will tell you what are those accounts. And at the end, you could see in the second part, there is something called overall balance. Right here, you could see there is something called overall balance. Now, this is the final balance that we are referring as balance of payments, right? Balance of payment after doing certain, category wise analysis, we are coming at this particular balance. We call it as overall balance, right? So these are some of the accounts that we are having when we prepare the balance of payments. Clear? Right. So let us see what are these accounts. Right. So now we are moving to the components of balance of payments. Right. Components of balance of payments. Now there we have mainly some account called current account, then capital and financial account, errors and omissions, overall balance, and something called changes that we do in our net foreign assets. Right. So these two are the fundamental parts coming under the balance of payment account, current account, and the capital and financial account. Right. So let us see. Now, if you look at the current account, that is the first account that you come across in your balance of payment. And it consists with basically these four accounts. Right? Current account consists with these four accounts. So simply you have your trading account, which represents the difference between your exports and imports. Then you have a particular document, particular account called service account. Again, it represents the difference between the service receipts that you obtained and the service payments that you have done. Right? So here it says transportation, tourism, information, technology, constructions, insurance, telecommunication, government expenses would be considered as the service account, right? Which means we are providing services for foreign countries. Accordingly, we are earning or we are paying. We are earning. And those country people providing services to us, accordingly, we have to pay them. So simply we need to take the difference between those two, right? Service account. Then the third one is income account. We can categorize this into primary income and secondary income, but we are not going to do that much of things. We are just looking at the income account. So it consists with employee compensation, direct investments, and interest and other. Simply the income that you earn by selling your factors. This not consider about the factors, but this consider about the factors, production factors. Trading account, service account, and the third one is income account. Fourth one is current transfer account. What do you mean by transfers? In a very simple way, transfers. Yeah, current means short term, nearly 1 year period. Transfers are what? Yes, transfers. Now, for example, let's say your good old days when you were schooling, your father gave you 50 rupees to buy the fish bar. Right? Did you give something for your father? Your father gave you 50 rupees to purchase a fish bar from your canteen. If you give something in return to your father, right? You will, so it's a transfer. There is no way, something like communication or transaction. There's a one-way transaction is there, right? Your father has given 50 rupees to you, but you have not given anything. You just purchase the fish bar and maybe. So those are we call as transfers. You are getting something, but you are not paying anything in return. Right? You are not paying anything in return. So those are, we call it as transfers. Transfers. Now there are two types of transfers, current transfers as well as official transfers. Sorry, private transfers as well as official transfers. Private transfer means like this, unrequired items, gift, you are getting some gifts. Right? Are you going to provide something? Donations, military aids, technical assistance which are received by non-government organizations. Right? Preferred remittances you are getting, but you are not going to get anything in return. Okay? And the other one, official transfer, official transfers. For example, let's say India has provided some particular items for us for a 1 year period. It could be medicine. Yes, Sri Lanka, you are facing severe economic crisis. Please take these medicines for a 1 year period. Is it a current transfer or not? Current transfer or not? It's a current transfer. Why? It's for a particular period of time and you are getting it from another country and you are not going to pay anything. Is it a private or official? It's official. Why? A particular sovereign nation is providing something for you. Right? The particular government body in a country providing something to a government body in another country. So it's official, not private. Clear? So we are considering these two as well when it comes to the current account balance. Okay, so these are the 4 sub accounts that we are having when it comes to the current account. Right, when it comes to the current account. So we are having trading account. It simply illustrates the difference between exports and exports. Then we have the service account. Again, it illustrates the difference between service income and service payments. Third one is our income account. It illustrates the income earned by our people, right? Then the fourth one is current transfer account. Current transfer account is consists with 2 private transfers and official. You need to get the summation between these two, not the difference. Huh? Most of the students are confused with these two because up to this point they are getting the differences. But here you need to add these two together. Here you need to add these two together. Right, so these are the 4 accounts that you have. Let us look at how you calculate these balances. Very simple. Trading account, it simply exports value minus imports value. Service account, service receipts minus service payments. Income account, income receipts minus income payments. Then, if you consider about only these 3 accounts, we call it as balance of trading, service and income. Only these 3 accounts. But if you incorporate your current transfer account, here you could see, you are adding the private transfers with official transfers, net. Right? Privately you may get and privately you may provide. Accordingly, you need to get the net back, impact of it. Then officially, you may receive certain donations from India and you may provide certain donations for USA. Right? So you need to consider, you need to get net balance of it. Right? You need to get the net balance of it. Use. So, good. We are big that's not yet. Could you please give me 3 minutes because I have to take my car. Just give me 3 minutes. Huh? Right. Okay, extremely sorry. Right, okay. Yeah, now, if you want to add, definitely you have to add the current transfer account into this particular component. Simply you need to add the net private transfers plus net official transfer. So finally, you are arriving at your current account balance if you get the summation of all these four accounts. Clear? So current account consists with four accounts. What are those? Trading account. You have exports and imports, service account, service income and service payments. Then you have income account, income receipts and income payments. Then finally, current transfer account. So you need to add all these balances in all these four accounts together. Then you will arrive at your what? Current account. Clear? Current account. Then we have another two accounts. That is, first, could you please look into this current account first? Current account is very easy, right? Current account. Right? Clear? So current account balance consists with balances of your trading account, income account, service account, and current transfer. Now we are going to look at another account. We have both these capital and financial account together, but we'll learn it separately. Capital account. Capital account, when it's come to the Sri Lankan context, we have only capital transfers. Now you have learned that something called current transfer for a particular period, let's say less than 1 year, you are getting something from foreign country. So it's a current transfer. Capital transfer is more than 1 year, you are getting something from another country. So those are the things that we have up to now. So here it says a country's capital account refers to any and all international capital transfers. Capital transfers, long-term needs. The overall expenditure and income are measured by inflows and outflows of funds in the forms of investments and loans flowing in and out of the economy. Mostly we are getting income, right? Are we paying some capital transfers to other countries? We may. As the deficit shows, more money is flowing out, while the surplus indicates more money is flowing in. Right? More money is flowing in. We are always waiting to look at whether we are getting money from other countries or capital transfers. Right, so this is how you calculate the balance, usual balance in your capital account, capital receipts minus capital payments, but here we only have capital transfers. Capital transfers. So capital transfers are what? Right, now according to this particular reference, Reserve Bank in Australia, here it says transactions where one party has transferred ownership of something to another party without receiving anything in a very specific way. You are providing something for another, but you are not expecting anything, but it's for a long-term purpose. Accordingly, it is a capital transfer. If it is a short-term one, what is that? It's a current transfer. For example, forgiveness of debt, so that the borrower no longer has to pay back what they borrowed. For example, let's say all the country says that Sri Lanka you don't want to claim forgiveness of the land. Right? So we are retaining the loans. Clear? So that is what we know as capital transfer. Some particular party is providing for us without expecting anything, and it is a long run aspect. Clear? Capital transfers. Capital transfers. Capital account. Here we are only having capital transfers. And the other one is the final account is financial account. Right? So if you look at the financial account, it consists with two things, simply long-term balance of your financial account and the short-term balance of your financial account. So here it says, these are some of the things that are coming under the financial account. These are long-term things that are arising or that we are providing, inserting in the financial account, and these are the short-term things. So you may have direct investment. So you know what are direct investments? What are those? Direct investments. Yes, here it says direct investment is investment undertaken by an entity resident in one economy, in an enterprise resident in another economy. So we have a port city. For port city, we are getting a lot of investments from other countries. So we can call it as direct investment. Right? Direct investment. So again, it's coming under the financial account. Then private long-term transaction, obtaining loans, obtaining long-term loans, as well as paying for those long-term loans. Then government, long-term government, they are obtaining long-term loans, then they are paying long-term loans. So all these are coming under your long-term financial account, right? Or financial account. And these are the short-term financial account aspects. Portfolio investments, simply if you do a stock market investment less than 1 year, it's a short-term investments. Then private short-term is there, like this one, we are getting loans and we are providing loans. Then net assets and net liabilities of the commercial bank, and we have to think about what are the increments and decrements of the assets of the commercial bank, as well as the increasing amounts, as well as the decreasing amount of the liabilities of the commercial banks. That is coming under this. And finally, government short-term, they are getting loans and they are paying those loans. Clear? So this is the long-term aspect, this is the short-term aspect, and this is how you calculate the balance in your financial account. Balance in your financial account. Now the long-term aspects. Yeah, you have direct investment. Usually, direct investment means one country is doing investment in another country. Right? They need to take the controlling power of that particular investment, and it is for a long-term period. And private long-term is there. Privately, companies, people are getting loans and they are paying for loan. And government long-term is also there. If you look at the short-term aspect, we have stock market investment. Again, private and government short-term plus the changes in the balances of the assets and the liabilities of commercial banks balance sheets. Right. So could you please read these two? Capital transfers, capital account, and financial account. So you will be getting a question, numerical question from this paper, and I have uploaded the question. I will also upload the answer to that one as well. Okay. DCT Kings. DCT Kings, example. See, this. Items. Say, items, release, brands, so there is nothing but expense, since we don't have those things. Other than that, then we can kind of also. We have things like the price from selling brands, raw materials. It's patents. Right, so here I have mentioned for I forgot to tell about this two sub accounts, but here we have only capital transfers. Other than that, we have another account to represents the things of the earnings that we obtain by selling payments, grants, right, royalties. We may have that one and have eliminated the capital transfers. So finally, if you add all these things together, you know how to get your current account balance. It's simply the summation of all balances of the sub accounts. Trading account balance, service account balance, income account balance, current transfer payment balance. You're getting your current account balance. Then you have your capital and financial account balance. So once you sum up these two together, you are getting what? Your overall balance, which is indicated there. Clear? Right, so here you could see, right, now here you have your current account. We already discussed about trading account, service account, and we discussed about income account, and I told you that we are just touching it. There are two aspects, your primary income and secondary income. Right, so here you don't have any current transfers. Then here it starts with capital account. Capital account. Then the balances of the capital and the current account together they have mentioned. Then here it starts with your financial account. You could see there are many things that are coming under your financial account. Many components, right? Many components, even though the space for the current account and the capital accounts are very much lower, you could say that the financial account balance here starts from here. And it starts from direct investment, other investment, up to this point it goes. So then what you have something called net errors and omissions. Hope you remember this at the very beginning when I was illustrating this. Here it says net errors and omission. You know how to get the current account balance, capital account balance, and overall balance. Here there is something called net errors and omissions. What do you mean by that? So when you are doing these calculations, there could be errors and omissions. So what you do, you adjust all those things at the end. Adjust all these things at the end. Net errors and omissions. Then finally, you get your overall balance. Clear? Overall balance. Right? You have to prepare a particular document like this in your examination is very simple, right? The things that we have, it's simply based on the things that we have done in the classroom. Right, so here you could see, what about the overall balance now? This is 2021 figure. So we are negative. So hope you remember that at the very beginning, I told you, we are preparing balance of payments. Basically with three objectives. What are those? We can identify the weaknesses and the strength of the international transactions. What do you think about by looking at this? Here, your exports are this much, imports are this much. Simply, we are running out of dollars. We are paying more. But I don't know whether you know this, our exports are dependent on imports. Our exports are dependent on imports. We are doing many exports, but for us to do such type of export, we need to have raw materials. So that we have to import. So we cannot say that as a strategy to minimize imports and increase exports. So we need dollars, we need imports for our exports. So it's a balance between these two, but still we are not in that position. Here you could see the balance, so simply the net impact is negative, trade balance. Now income account, secondary income is somewhat okay, and capital account is anyway positive. That financial account figures. Ultimately, overall balance is negative. Net impact is negative, so which means we are in a weaker position. And the second objective is what? We can use this BOP for last few years and we can do the comparison. Now you have 2 years for this comparison, 2020 as well as 2021. What do you think? It's negative. It's negative. And the third objective is by looking at these things, we can take policy decisions. So if we have witnessed that this much of a negative performance, we have to take certain actions, right? Starting from this point to this point, because you are getting your overall balance based on current account, trading, capital account, and financial account. So you need to do certain adjustments in there. Otherwise, you cannot get this. Okay. Yes, online students, are you all okay with this?
Yes, sir.
Right. Okay. So what are the things that you know up to now? You know what balance. Just think whether you know these things are at least 40%, whether you are okay with these things. Right. So balance of payment is what? It's a particular statement that every country prepares to identify whether they have make a gain or a make a loss by engaging in international transactions. That is how we simply define what balance of payment is, but there's a more specific definition as well. Simple definitions, right? So now when it comes to the balance of payment, you learn that we have current account, capital account, and financial account. Current account consists with how many accounts? 4 sub-accounts. So you have trading account, which shows the difference between exports and imports. Then you have service account. Again, it shows the difference between service receipts and service payment. Third account is what? Income account. Again, it shows the difference between income receipts and income payments. Fourth one, current transfer. You need to add private and official transfers together. Then, once you get the summation of all these balances, you are getting the current account balance. Then, if you look at the capital account, we have only capital transfers. Then, financial account, there are many components coming under financial account. So, if you sum up your current account with capital and financial account, you are getting what? Overall balance. Overall balance in your balance of payment. Clear? Right. Then we have another component called net foreign assets, changes in the net foreign assets, right? Changes in the net foreign assets. Now, if I ask this in a very simple way, now tell me, yeah, it's dollars, right? Now it's dollars. Now, what does this mean? Yeah, our overall balance is negative. What does it mean in a very simple way? Increasing our loans. Simply we have to pay, right? We have to pay. So our overall balance, right? Our overall balance is a negative figure. It's 2328. It's a negative figure. So which means we have to pay this amount to the rest of the world in a very simple way. So from where you finance this? Very good. You finance this by your reserves. Right? So you have something called reserves. So how much you are going to get? How much you are going to get from the reserves? Very good. Is it a positive impact or negative impact here? It's negative. So we are getting this much from our reserves. Then we put it here. Finally, it's zero. So we call this as changes in the net foreign assets or the monetary movement. The things that we do to our reserves, because we obtain a negative figure, which means we have to pay this to the rest of the world, and we have to pay this in terms of rupees or dollars. We have to pay this in terms of dollars. Are we having dollars? We are having dollars. Where? In the reserves. So we need to pick the same amount and we need to paste it here. Clear? Let's assume our overall balance is, let's say, this much. Overall balance is this much. It's $5,000. Now what we are going to do? Yes. What we are going to do? Very good. Since we earn dollars, we go and put this into here. Right? We go and put this into here. Again, it's equal. Okay, very simple. So we call this as the changes that you do to your foreign reserves. We call it as changes in the net foreign assets, net foreign reserves. Clear? If we don't have reserves, what we have to do? We have to go to the loans, domestic loans as well as foreign. Simple. Simple. So that is the meaning of changes in net foreign assets. So the reserves that we do monetary movements. Clear? Yes, online students, are you okay with that?
Yes, sir.
Right. All of you clear with that? Is it okay? Clear? All of you. Right. Okay, fine. So now we are going to discuss about balance of payment issues. Issues that we are having in the balance of payment. Right. So in your LMS, I will open a discussion forum. Not now, it's already there. I will show it to you. So what you have to do, you have to have a proper discussion about this particular item, balance of payment issues and its impact to the economy and what are the solutions. For an example, simply let's say you are providing, yes, these are the issues that we are having. What is its impact? Then what are the suggestions that you put into that? Likewise, and you can comment for that particular way. Likewise, I need to have a particular discussion forum in the LMS. I will open the discussion forum and let you. You can comment to others' arguments as well. I you can comment. You can say these are the issues that we have. Accordingly, this would be the impact. Right? We don't have electricity. Come on. Then what are the solutions? What are the solutions? And you can argue between two people. So I will open a discussion forum for that. And so some of the actions could also be there. Now, if we have a particular, let's say, some issues in the balance of payments, now some of the actions I have mentioned here right? For you to make it very simple, if we obtain a deficit BOP means we have to pay to the rest of the world, which means which is because of the issues that we are having in our current account, capital account, in the financial account. Right? So these are some of the actions that we could take. Right. So develop import substitute industries. Now why to do that? Our exports are heavily depend on imports. In your international trade, you got to know that we need to have export growth strategy as well as import substitutions. So better to have import substitution industries. So we are talking about these things from decades. Right? Then control domestic inflation and increase export competition. Right now, what do you mean by this? Control domestic inflation and increase export competition. If our domestic inflation is high, simply if our domestic price level is high, what do you think about the prices of the goods that we are exporting? Will it be higher or lower? Higher or lower? It will be higher because domestic inflation is high. Accordingly, the things that you export, the prices will also be high. So therefore, what will happen? Foreigners, they have many substitute products rather than other countries' products, so they will go for those products. So that's why it says we need to control the domestic inflation, whereby we can achieve the export competition. The export company, because we are offering a reasonable price, competitive price to the market. Okay, reduction of unnecessary imports, export diversification, not based on those traditional export, we need to diversify many things. Engage in foreign trade agreements with many countries, improve competency, encourage non-traditional export. This is actually links with this export diversification as well. Develop export promotion zones. So, for the moment, we have how many promotion zones we have? Export promotion zones. How many? 3. What are those? Two. What are those? Huh? Yes, Patnagar. Oh. We need to have many of these things. Right, so these are some of the actions that we can take. Please engage in this discussion forum. Right, please engage in this discussion forum. Right, okay. So that is all about balance of payments. Right, that is all about balance of payment. You know what balance of payment is, its accounts, how to calculate the balances of those accounts, and finally the overall balances. And if the overall balance is positive, what you need to do, and if it is negative, what you need to do. So you are getting this kind of a question in your paper as well, and the formulas will also be there. Do I want to give the formulas? Huh? Yes. Right. So that's all about the balance of payment, and you need to engage in that discussion forum by mentioning the issues of balance of payment and the solutions. And these are some of the solutions that I have made. Do we need a break? Yes, of course, 20-minute break. Nice students, are you all okay with these things? Any
Hi,
doubts?
sir. Excuse me. Hi, sir.
Yeah.
So, how did you get this central bank balance of payment analytical report? I just
Yes.
checked now, but I could not
Yeah.
find it.
Yeah. So have you go to that annual reports part? Just a moment. Let's see. Can you see the screen?
Yes, sir.
Exchange central bank annual reports, publications. Right, so here you could see publications. Under publications, here economic and financial report. Here, better you click the annual report.
Okay.
Little by little, and move forward like this. Just
Okay.
click this. Just to let us take this, and here you can see now it's very easy, right? They are separately mentioning each and every segment, so it's very easy. So external sector development and policies. Then, yes, here you could see. Clear?
Oh, okay, sir.
That's fine. Good.
Okay, sir. Thank you very much.
So here we are taking a break of 20 minutes. Right. Yes, online students, are you there? Yes, sir. Right. Okay, so we are going to, now this session, we are going to start the foreign exchange rates. Again, a very easy topic. Finally, we can complete and we'll give some hints. Paper structure. So do you have your exams starting? 7th of April. Nice date. Finish your BCC economics. April 9th. Marvelous. Nice date, no? Good. Okay. So online students, you are having exams online, right? Online students, you have exams online, right?
Yes, sir, but they didn't, still they didn't send much information regarding that thing.
Okay, they will definitely, they will, and you may have some training session as well. Right?
Yes.
So no worries, huh? They will send. Right, okay, so
Sir,
we'll start. Yes, yes.
So, can you give some idea about what are the area that you're going to check in the exam?
Sure.
Is it possible?
Sure. Finally, I'll tell you. Study the entire syllabus. How marvelous.
Not entire syllabus.
I'll definitely give up. I'll illustrate the paper structure and everything. Huh?
Okay, thank you, sir.
That's the most important element, isn't it? So then I'll tell you these are the things. Then I'm preparing a deeper topic. Oh, nice. Right. Okay. Fine. So we'll start our final part. Right. So it's foreign exchange rates. Right. Foreign exchange rates. Now, what do you mean by foreign exchange rates? Very simple topic. Yes. Yes, good. In a very simple way, value of a currency in terms of another currency. Value of one currency in terms of another currency. So that's what we know as foreign exchange rates. Now, right, so we know that when it's come to the world, now what are the currencies that we have? What are the currencies? Yes. What are the currencies that we have? What? Currencies. Ah, okay, fine. So, right, okay. Right. So let's say here you have dollar, right? And here you have GBP, right? Then, yes. Here, let's say you have euro. Now, how we are getting the foreign exchange rate? Simply, for dollar, we have a supply of dollar and we have the demand for dollar. When it's come to the GBP, we have the supply and we have the demand. When it's come to the euro also, supply is there and the demand is also there. Now, based on this demand and supply, foreign exchange rates is determined. There are certain regimes, but considering about the floating exchange rates, based on the demand and supply, foreign exchange rates are being determined. Now, here it say, let's say it's 370 rupees per 1 rupee. Here it's how much? GBP. Let's say it's 400. Here it's euro. let's say 600, right? 600. So this is how the exchange rates are being determined, right? Based on the demand and supply for each and every currency, foreign exchange rate is determined. So if you consider all these, now this is a market, this is the euro market, this is the market for GBP, and this is the dollar market. So if you consider all these markets together, we can call it as foreign exchange rate market. Foreign exchange rate markets. Markets where the different foreign currencies are traded. That is what we know as foreign exchange market. Clear? Now within this market, foreign exchange rates are determined. Then what is foreign exchange rates? It's simply value of a one currency in terms of another currency. This is foreign exchange rate. Value of, very simple, value of one currency in terms of another currency. Value of one currency in terms of another currency. Now, there are two methods where we can produce or provide these exchange rates. First one, we call it as direct or price quotation. Right? Direct or price quotation. And the second one is indirect or volume quotation. Direct or indirect or these are the two things. Clear? So when it's come to the direct or the price quotation, simply it's same as this. It's same as this. Right? So we are elaborating value of a foreign currency in terms of local currency. How much local currencies do we need to pay to buy $1? Clear? How much of domestic currency do we need to pay to buy $1? That is direct quotation. Indirect means how much of US dollars must be exchanged to purchase 1 rupee. How do we calculate it? It's simply, yes, 1 rupee equals to how many dollars? It's simply 301 divided by 370. How much is it? 1 divided by 370. Calculators, 1 divided by 370. One divided by 370. 0.002. 0.007. Right, look at this. If we as Sri Lankan wants to buy $1, we have to pay 370 rupees, our domestic currency. But if a US person wants to purchase 1 rupee, he has to pay how many US dollars? This much. So this illustrates whether the currency is strong or not. Right? But we will do further analysis. Clear? Right. So different markets are there for different foreign exchange rates. So within those markets, foreign exchange rates are determined. All together, we call it as foreign exchange market. Foreign exchange rate is value. Simply we are providing the value of a one currency in terms of another currency. Then this illustration, we can divide it into two, either by direct quotation or indirect quotation. Clear? Right. So where is that knowledge? Let's see. Here it says, foreign exchange market is the market where the currency of a one country is exchanged for the currency of another country. Here you could see we have to pay 370 rupees to buy $1. right? Or the US person must want to pay $0.0027 to purchase 1 rupee. The foreign exchange rate is the price of one currency in terms of another currency. Simply, that is this. The foreign exchange rate is determined in the foreign exchange market. This is how the foreign exchange rates are determined. Clear? Then here it says key terms applicable in exchange rates. So we have something called direct quotation, indirect quotation, spot exchange rate, and the other one is forward exchange rate. So direct quotation. Now this is the direct quotation. This is direct quotation. So we call this as price quotation. It says direct quotation is when 1 unit of foreign currency, 1 unit of foreign currency is expressed in terms of the domestic currency. 1 unit of foreign currency is expressed in terms of domestic currency. And the other one is indirect quotation. What it says is when 1 unit of domestic currency, 1 unit of domestic currency is expressed in terms of foreign currency. That is indirect quotation. Spot exchange rate means what? Spot. On the spot. Spot exchange rate means what? If you are going to do a particular transaction now, the exchange rate which is applicable at the moment. At the moment, because at the usually you are getting the opening exchange rate and the ending exchange rate per day. But in between, there are certain movements based on the demand and supply. So if you are going to do a particular transaction, let's say just now the time is 250, the rate which is applicable now is known as spot exchange rate. Spot exchange rate. Here it says the spot exchange rate is the rate at which currency can be bought or sold for immediate delivery. Immediately. Right? Immediately. And the other one is forward exchange rates. What do you mean by forward exchange rates? Any idea? Forward exchange rates? Yes. So future exchange rate. For an example, you are going to buy a particular vehicle, right? Shall I do it here on listeners? Can you see if I do the illustration in here? Can you also if I do the illustration here?
Yes, sir. If you could use some dark color pen, then
Okay,
it should be okay.
black. Okay, sure. Right. So for an example, let's say here you are the buyer. Right? You are the buyer. And this side, there is a seller. Right? So there's a particular vehicle. There's a particular vehicle, right? So today, the date is, let's say, 19th March 2023, right? So today, what will happen? You agreed to buy this vehicle on a future date, right? Today, you are making that agreement to buy this motor vehicle on a future date. Let's say the date will be 31st of March 2023. Right? You are going to say to your seller, yes, look, I will purchase this particular motor vehicle in a future date, right? So let's make that agreement, right? Let's make that agreement. Now the forward exchange rate means the rate applicable on that date, right? Or the predetermined exchange rate. So there's a particular method that you are arriving at your forward exchange rate. So based on that, you can determine the forward exchange rate. And so simply you are making an agreement to purchase this particular vehicle on a future date on a predetermined exchange rate. So we call it as forward exchange rate. So if the exchange rate is lower or higher than that rate, can't help, you have to purchase and that person has to sell. There there could be certain losses as well as profits as well based on that. So that is simply forward exchange rate which is applicable in the future days. So here it says the forward exchange rate is the rate that is currently paid for the delivery of a currency at some future date. Future date. So these are the basic four terms which is applicable in exchange rate. Direct quotation is there. Indirect quotation, spot exchange rate means now. Forward exchange rate means future. Clear? Right. Okay, so now we are going to look into the different activities in foreign exchange market. Different activities. Right. Now, the first one that we are going to discuss is speculation. Right? Speculation. Have you heard this word? What do you mean by speculation? Speculation means what? Now, if I put it very simple way, without talking about the speculation and other stuff, usually you are buying a particular product. Forget about foreign exchange market. You are buying a particular product when its value is lower. I'm not mentioning the technical word for that. Whether that value is lower or high. It is lower. You are going to sell a particular thing if it is high or lower. High or lower. High. Right? For an example, let's say now during the last 2 years, we observed that there's a significant price movement in the second-hand markets for the vehicle. Right? What happens? Prices were high or lower. Prices are high, very high. Right? Sometimes the actual price of the particular vehicle could be 20 lakhs, but it has been sold for a price of 35 lakhs. So in such kind of a situation, what you do? You are going to sell your car or not? Sell your car. Because by selling your car, you are getting the high value. You actually know that your car are only worth 20 lakhs, but you can sell your car more than that. Which means the car is overvalued. The market. The car is overvalued in the market. So therefore, what you do? You sell your car. Then, on the other hand, so you are searching for a car. You are searching for a car, and you believe that this car is 20 lakhs. But once you go to the market and have a discussion with the particular seller, you can purchase that car for 15 lakhs. What you could do? You are going to buy or hold. You are going to buy because you believe for you the actual worth of the car is 20 lakhs. But it is being traded in the market at a lower price than that. 15 lakhs undervalued. So which means you are purchasing that. So you purchase when a particular asset is undervalued. You sell if the particular asset is overvalued. That theory applies in the speculation. Speculation. But here the risk is very high. Right? When it comes to the speculation, what happens? You are buying a particular asset when it is undervalued. You are selling a particular asset when it is overvalued. But the risk is high. Right? The risk is high. You are doing very small analysis and you make your decisions right? By certain assumptions, certain hunches, right? Certain announcements, certain rumors. Based on those elements, you are making your decision. That is why we say this is the high risky part. Right? If somebody says, yes, Forex is going to happen, this, you are going to buy or you are going to sell without doing much analysis. Right? So speculation means that. So you may have some experiences as well. So here it says, speculation in foreign exchange is an act of buying and selling foreign currency under the conditions of uncertainty with the view of earning huge gains. What do you mean by uncertainty? In the difference between risk and uncertainty is what is the difference between these two? Risk and uncertainty? Is there any difference? Is that the difference? What is the difference? So risk, because those are rules. That's the difference. So risk, you can predict.